We turn now to the growing level of economic uncertainty surrounding the North American auto industry. The big three are navigating a new era as they deal with the impact of President Trump's tariffs.
Donald Trump says he wants every car sold in the U.S. to be made in the U.S., and he's willing to disrupt an entire industry to make that happen.
We turn now to the deepening crisis inside America's manufacturing backbone, a story that blends policy decisions in Washington, the hard realities of global competition, and the personal struggles of workers in factory towns across the United States, where generations once counted on the auto industry as the heart of economic security. And while I respect the decision by President Trump and his administration to defend American industries through tariffs and tough trade measures, it is also my responsibility to lay out the facts, the numbers, and the ripple effects shaping both the economy and everyday lives, because the collapse of Chevrolet's U.S. production is not just another headline, but a case study in how globalization, supply chain fragility, and government policy collide. This week, General Motors confirmed cuts of nearly 14,000 jobs, about 15% of its salaried workforce, and the silence in once busy plants in Michigan, Texas, and Missouri stands as a reminder of how quickly billions in output can vanish, leaving communities like Flint and Toledo in shock. And if we look at the broader picture, U.S. auto employment has been shrinking for decades, falling from more than 1 million assembly line jobs in the 1970s to fewer than 600,000 today, according to the Bureau of Labor Statistics, a trajectory worsened by automation, offshoring, and trade disputes. Chevrolet's shutdown of U.S. lines that produced models like the Silverado, Tahoe, and Blazer immediately wiped out local paychecks and triggered ripple effects for suppliers, contractors, and transport companies. And while Wall Street initially applauded GM's move as a strategic reset, with GM's stock jumping before sliding back nearly 7%, ordinary families saw only canceled shifts and unpaid mortgages, a reality that highlights the widening disconnect between financial markets and working-class households. Union leaders at the United Auto Workers have responded with rolling protests, signaling a willingness to strike if necessary, a move reminiscent of the 2019 UAW strike that cost GM nearly $4 billion in just 6 weeks, while consumer frustration is mounting as well, with cancellations and boycotts threatening long-term brand trust. Behind all of this is the core issue of tariffs, where Washington's 25% duty on imported auto parts, introduced under President Trump's America First strategy, was designed to protect domestic factories. Yet according to the Center for Automotive Research, tariffs have cost the global auto sector nearly $12 billion to date and raised average vehicle prices in the U.S. by $300, with large pickup trucks, the very models driving Detroit's profits, climbing by as much as $1,000, a hidden tax that is especially painful for retirees and middle-income households already squeezed by inflation. GM alone reported a $1.1 billion tariff-related hit in one quarter, with forecasts warning of $5 billion in annual losses if policies remain unchanged, and Ford, facing similar headwinds, has publicly warned of profit erosion in the billions, underscoring that this is not just a GM issue, but an industry-wide crisis. The complexity deepens when we consider supply chains, because even vehicles branded Made in America, like the Chevrolet Silverado, rely on engines, electronics, and steel sourced from Mexico, Canada, Germany, and Japan, and every border. Crossing now involves fees, delays, and multiple layers of taxation, a reality that undermines the just-in-time production system the industry has perfected since the 1980s. GM's leadership, while publicly thanking Washington for its support, has privately admitted it is running survival scenarios, including shifting more production overseas, and in fact, plants in Mexico and South Korea have already absorbed much of the output, once anchored in U.S. towns where wages are far lower. Mexican workers at GM earn as little as $5.50 an hour, compared with $35 in Michigan, an imbalance that keeps the company alive financially but sparks resentment both north and south of the border, with Mexican unions threatening strikes for higher pay and U.S. unions denouncing the move as betrayal. Politically, the tension is boiling as well, with President Trump at one point floating a $100 100% tariff on imported Chevrolet vehicles to force production back home, a move that would have likely ignited retaliation from Canada and Mexico, both of whom hinted at countermeasures that could have cost American exporters billions, while China, already in a tariff standoff with Washington, slapped new duties on U.S.-made SUVs and pickups, effectively choking Cadillac's expansion in one of the world's largest car markets, leaving German, Japanese, and Korean automakers to step in and seize market share. When we look at this landscape from a distance, it becomes clear that Chevrolet's collapse is not just about one company, but about a shifting global order where American industrial dominance, once unquestioned, is now being challenged on every front. And while I respect the leadership's intention to protect American jobs, the data shows a different reality. Factories are closing, communities are losing their anchor employers, and rivals abroad are gaining strength. If we look historically, in 1965, GM alone controlled over 50% of the U.S. auto market. Today, that share is closer to 17%, while Toyota, Hyundai, and Volkswagen have grown steadily, benefiting from consistent policy and global supply chains. And the real danger is that protectionism, rather than shielding U.S. workers, may accelerate the erosion by pushing companies to relocate even more aggressively to lower-cost regions. This isn't to say recovery is impossible, because GM has pledged $4 billion to bring models like the Blazer and Equinox back to U.S. assembly lines by 2027, with Fort Wayne, Indiana ramping up production as a sign of commitment. But the scale of that return, just 3,000 vehicles per year, is a fraction of what has been lost, raising the question of whether it will be enough. Meanwhile, the average American car buyer, especially older citizens on fixed incomes, will feel the pinch as vehicle prices creep upward. Financing becomes tougher, and domestic dealerships face declining inventory, a chain reaction that filters into everything from real estate values in factory towns to tax revenues for local governments that depend on auto payrolls. In my view, the Chevrolet crisis is less about one administration and more about a long-term failure of U.S. policy to adapt to a globalized, high-tech, and competitive auto market. Because while Washington debates tariffs, other nations are pouring billions into electric vehicles, batteries, and AI-driven mobility, with China now controlling more than 60% of the world's EV battery supply chain, and Europe committing nearly $40 billion to EV infrastructure investments that position them as future leaders while U.S. companies struggle to keep pace. If America wants to avoid a slow decline in industrial power, the solution must go beyond tariffs toward real investment in innovation, workforce training, and modern infrastructure. Otherwise, plant closures like Chevrolet's will not be the exception, but the rule. And so, we stand at a crossroads. One path leading to resilience and renewal if bold steps are taken, the other leading to further erosion of the manufacturing base that once defined the U.S. economy. And the question is no longer whether tariffs alone can save jobs. They cannot. But whether policymakers, companies, and workers together can build a new strategy that protects livelihoods without isolating America from the global marketplace. Because at the end of the day, this story is not just about stocks or about Washington politics, but about the very families who built their lives on the promise of Made in America and now watch that promise fracture, and whether future generations will inherit an economy defined by strength or by struggle remains the defining challenge of our time.